Hey everyone, welcome back to the channel. Today we're going to do a little three-part mini-series on SPACs. We're going to look at VGAC. If you're not familiar, that's the SPAC that announced back in February that they were merging with 23andMe. So we're in this three-part series. We're going to kick it off first. We're just going to do a little SPAC overview, talk to you about what a SPAC is, why as a retail investor we should probably avoid them now that I actually look more into them. And then we'll go into VGAC, its structure, and then 23andMe, which I think is actually a really interesting company. So we'll talk a little bit about them, and then just the economics of SPAC investing. So just to kick it off, if you're not aware of what a SPAC is, it's a special purpose acquisition company. Um, it's a big fancy name for saying a blank check company. They go raise a bunch of money from the public, and then they take that money and they go buy a private company with it. Most of the time, it's going to be founded by a kind of celebrity investor or, someone like that, like a Richard Branson, a Bill Ackman of the world. Those are the kind of people really leading SPACs because you got to have a big name to be able to raise the capital because people are buying your leadership skills, right? Your ability to go find a good deal. Um, They'll usually focus on a sector or an industry that the founding members know pretty well. Um, if you're not familiar with kind of the ins and outs, they can't just like run with your money. After you invest in the IPO, the money's tied up in a trust until they go acquire a company. So your money's safe for the most part. There's some minor costs like rent and stuff that can be pulled out of there, maybe some legal fees, but nothing major. And they have 18 to 24 months to go acquire a company. I believe this is like FINRA regulated. So if they don't find something within 24 months, investors get their money back from the trust. So, I mean, really, the reason SPACs are attractive for private companies is if they're smaller, right? It could be a difficult process to do a traditional IPO or a direct listing. You may not have the resources or skills necessary. Or if a company needs to IPO quickly, which honestly I think is the 23andMe scenario here. I think they were more worried about IPOing and getting some liquidity for their investors. We'll touch on that in a bit. But just something to really highlight here, since 2015, 93 of the 313 SPACs that have IPO'd have actually only completed mergers or taken a company public, so about a third, right, have only actually been able to acquire something, the rest return the money back to investors. Um, and of these 93, the average return is a loss of 9.6%. The median return is a loss of 29%. Um, and of these 90 companies, only a third of them, so 30 of them, have actually returned a profit in that 5-year time span to investors. This is compared to the average return of 47% for traditional IPOs since 2015. If you're interested where this data is coming from, Renaissance Capital actually published a report on it. There's a footnote on the slide. Feel free to go look at this. I think you do have to sign up to view the whole report, um, but just kind of some high level data there on that. One other thing to note is SPACs have a pretty straightforward S1, which is their IPO filing. It's a little bit summary risk factors. A lot of this though is just very kind of boilerplate, um, more or less. So uh, it's not super difficult as a SPAC to really go public. You don't have any financials to be audited. Whereas if we look at like a traditional S1, right, this is a full team of lawyers and investment bankers spending a lot of time putting together this really nice marketing book um, to go market it around. So just a little bit of the difference there. Last thing I want to touch on here is called what I'm calling Spaconomics. This is really like why SPACs lose so much money for investors most of the time. And so the example we'll give you here, but just so you're aware, when a SPAC is set up, the founders are either they're basically given a large percentage of the SPAC, and if they don't do it right away, they'll bury it somewhere in there, and it'll happen at the time of a merger, and it's usually in the range of 15 to 20%, which is quite a bit when you do the math. So here's an example, and we'll do this example again for VGAC, and you can see what I'm talking about here. But SPAC one, $25,000 is funded by the founders, and for that they get 2 million shares of Class B stock. So this is kind of like when the SPAC is founded, you need a little bit of capital to kind of incorporate, do some small things like that. Um, then from there, what happens is they're going to go raise $100 million via IPO at $10 a share. So 10 million additional shares will be issued, and these shares will be Class A. So they do this, they'll give themselves two different classes of shares. Class B will hold all the rights up until an acquisition happens. So pick the board of directors and pick the company they're acquiring. Class A investors will have just about zero rights. So immediately after the IPO, right, shareholders are already diluted. There's now 1.2 million or 10.12 million shares outstanding, not 1.2, sorry. Excuse that decimal point. But there's only 100 million and $25,000 of assets. So, right, the equity value now, 100 million divided by 12 is 833 a share. SPAC founders, this is great. They're 2 million shares. It's now worth, that they paid $25,000 for is now worth 16 million. Just overnight by IPOing. They don't even have a company, you know, they just filled out an S1 template and they're like, buy into my ideas. Crazy, right? And you know, the alternative here, right, is private equity, right? If we look at that, they have a 2 and 20 model, 2% management fee, and then 20% of profits. So 2% of assets under management in the same example would be $2 million a year. So you could invest with private equity for 8 years with them doing nothing and come out just as good as you are here. So the math does not work in the favor of the investor in a SPAC. It works in the favor of the retail investor, and then usually the company that they're taking public gets a big payday as well. So it's kind of everyone's best interest except for the investors that end up buying the SPAC shares, which is usually going to be retail investors because you'll have all your institutional investors buying the IPO and then they'll instantly sell it because retail investors or whatever will want some exposure to this. So yeah, this is the first video of 3, like I said. In the next video, we're going to look at VGAC, a little bit of their structure, and then we'll do a third video on 23andMe, and then the Spaconomics of that SPAC as well. So yeah, if you have any questions or comments, leave them below. If not, check out the playlist and watch the second video in the series. Thanks.